And thank you to the Chilean Central Bank for an opportunity to be here to share some of the work that BEA is doing on digital economy. So the overall objective of this work is to better measure the digital economy and further capture technology's role in economic growth. The work is funded in part by our National Telecommunications and Information Administration, and there are a number of streams of work that we're engaging in right now at BEA. The ones that I've highlighted here in red are those that I'll talk about today. The first is defining the digital economy and capturing its contribution to economic growth. This is the work toward a digital economy satellite account, and I'll talk more about this. We've also had ongoing and recent work to improve price and volume measures of high-tech products. Likewise, measuring the economic contribution of cloud computing. I'm going to talk a little bit about new work that we have in this area and some very preliminary estimates that will eventually fit into the OECD Digital Supply Use Table framework. We're starting to work on estimating the digital component of structures. This is new work and we don't have any results to show here yet, but they would be forthcoming. And then fifth, evaluating the changing role of data and reconsidering its treatment in national accounts. We've heard a little bit about this in previous presentations. Today I'm going to talk a little bit more as well on recent work at BEA and a collaboration that we have with Stats Canada in this area. And then finally, estimating the contribution of free digital media and internet services. So these are advertising supported or marketing supported services. There's been work in this area at BEA for a number of years and in other agencies as well. I'm not going to say that much about them in here today. So first is the digital economy satellite account. We released initial results in March of 2018 and an update in April of this year in 2019. Our time series for the satellite account with that update spans 1997 through 2017, and there are reports for each of these from March 2018 and April 2019 on BEA's website. And for the most part, we've tried to achieve some consistency with guidance that's coming out of the OECD informal advisory group on measuring GDP in the digital age. We have efforts underway currently to fully harmonize with the digital supply use tables that have been the framework that's been developed by that advisory group, and a fully consistent and harmonized digital SUT will be forthcoming as well. So I'm going to say a bit about our methodology for making estimates of digital economy. It's a three-step methodology. The first is a conceptual definition. Since we were funded in part by our NTIA, we had to be somewhat concrete in terms of what we were trying to measure and include as part of the digital economy. The second step is identifying digital goods and services, and the third is identifying the industries that are producing those digital goods and services. So for the first step, our structure of estimates or conceptual definition, there are four components here. The first is digital enabling infrastructure, which are the goods and services needed for interconnected computer networks to exist and operate. And the pieces of these include hardware and computer software, telecommunication services, support services, and then I've highlighted in blue and italicized here those areas that are included in this part of the definition but that we haven't included in our estimates as of yet for lack of source data or appropriate methodology. So Internet of Things or IoT and structures. We haven't been able to split those into digital and non-digital components. The second component of the definition is e-commerce, and these are digital transactions that use the computer networks that we outline under digital enabling infrastructure. This includes digitally ordered goods and services, both B2B or business to business and B2C, business to consumer. And also includes paid services for digital intermediation. These are online platforms, peer-to-peer type transactions. Again, highlighted in blue because as we've already heard, this is a somewhat challenging area, even though a lot of this activity is already included, of course, in national accounts estimates. Separating out and actually treating the fees for the intermediation has been somewhat of a challenge. The third component is digital media, which are the content that users create and access, and these are include digitally delivered services, except cloud, which is our fourth component under the definition, and then except e-commerce or digitally intermediary services under e-commerce. And then we also include in here, but have not estimated or included as part of the digital economy estimates, free digital services, the advertising supported services, and data, which I'll talk a little bit more about as part of this presentation. And then the fourth component is services for cloud computing, those that are paid. For the second step, identifying digital goods and services, we use BEA's official supply use tables for this exercise. There are approximately 5,000 categories of products that are included in the underlying detail of our tables. And we initially identified just over 200 categories as primarily digital products. And we more recently have identified another 27 product categories that belong in the primarily digital category as well. We initially, and have still left out any partially digital products. We initially included a couple of wholesale retail trade margins that are primarily digital, and we're more recently, in our next update as well, planning to include some partially digital trade margins as well. And the third step, identifying the industries that produce these products. The first is to come up with a calculation of gross output, which is just the sum of gross output for all those products that have been determined to be within scope, up in step 2. And then our measures of value-added compensation and employment are derived from ratios of the digital economy gross output to total gross output. So this is a relatively strong assumption here, but it's the best that we can do with current data sources under this methodology. We use a double deflation method, so for both gross output and intermediate consumption for the real measures. And here's one of our results. We're looking at industry shares of GDP, and we've highlighted what turns out to be a digital economy industry that we're showing as a digital economy industry here of 9% for 2017. So these are current dollar values. And if you went ahead and added up the shares across all the industries that are shown here, we'd yield about 100%. So the activity that's included in the digital economy industry here has been excluded and taken out of these other industries. So it falls in between manufacturing and finance and insurance. And a little bit different perspective on digital economy as a share of GDP. On the left, we're measuring digital economy current dollar value added in the orange bars along the bottom in the left-hand vertical axis. And then on the right vertical axis, this is our share of total current dollar GDP. So in 2017, that value we just saw on the previous slide is 9%, and you can see how that's unfolded over the last 20 years, 1997 to 2017. So a steady increase in the current dollar value as well as the share of GDP. And here we're looking at contributions to real GDP growth. Real GDP growth is shown in this slide as the light blue dots, and we can see here that the contributions at the beginning of the time period shown here is relatively small if we compare it to some of the more recent years. It dips down in growth itself, dips down in 2001, 2002 during the tech industry decline, and then in the Great Recession 2008, 2009, digital economy was the only positive contribution to real GDP growth in those years. And it took a while to catch up after the Great Recession. You can see the blue areas here are a little bit smaller, but they've increased in more recent years, even relative to real GDP growth in those years. So we find a bigger contribution in more recent years. Here are component shares of current dollar digital economy value added. Each bar here is a year from 2002 to 2017, and we've included our product categories here at the bottom: hardware, software, telecommunications, support services, digitally ordered goods and services, cloud computing services, and then the last category being digitally delivered services. And you can see that for a couple of these categories over this period, 2002 to 2017, there have been some declines in the component share for hardware and for telecommunication services. But for the most part, in these other categories, there have been increases over time. Software is a little bit more subtle. We don't treat open source software, of course, as capital formation, so that excludes any open source software that is making an important difference. Support services, also a steady and slower decline, and then much larger increases for digitally ordered goods and services, as well as cloud computing and digitally delivered on the right-hand side. And then finally here we're looking at components of the digital economy. This is average annual growth in real value added for the period 2008 through 2017. For total economy, the average annual growth over this period was just under 2%, so it's quite low, but for digital economy portion, it's just over 6%. You can see how the components contribute to this, with the largest over 8 percentage points, 8% for cloud computing services, digitally delivered services, and support services, and still between 4 and 6% for the 4 remaining software, digitally ordered goods and services, telecommunications, and hardware. So I mentioned at the beginning that an area where we've made some recent progress is preliminary estimates of cloud computing services. So prior to the 2018 comprehensive update of the National Income and Product Accounts, it came to our attention that there was some slow growth in investment of ICT. And we realized that what was happening was that there was some component parts for server farms that were being imported or even produced domestically that weren't making their way into our traditional capital expenditure surveys. Instead, they were being treated as intermediate consumption. So this is something that we changed in the 2008 comprehensive update. But along with that is measuring services for cloud computing themselves, this outsourcing of computing activities, storage management, and data analytics. And so the area that we focused on for this is NAICS 518. This is data processing, hosting, and related services. There are a lot of activities in this area that are important and related to cloud computing activities, some of which are shown here. So data processing, storage, and data management, as well as information and document transformation services. And the estimates, the preliminary estimates that we've come up with are shown here for real value added using a methodology that we've used for other digital components. About $15 billion in 2002 and has grown to just over $80 billion in 2017. The 2002, 2007, and 2012 estimates come from our economic census and the products that have been identified in those data. And then we've extrapolated after 2012 using a proprietary data source. And we see a dip here for 2012-13, which is a result of consolidation in the industry as well as a real slowdown related to some security security concerns as well. Okay, so from here I want to move into a bit of explanation of some work that we're doing on data, and I want to be clear that we're talking here about valuation and use, collection of and use of data, stocks and flows as a productive resource, not in the compilation of official statistics, right? So we're not talking about the use of big data in compilation of official statistics. And just as sort of a case study basis or some concrete examples to get a sense of why this has come up, and it's been a collaboration between Stats Canada and the US. A couple of areas that we've been focusing on are IoT sensor data. So this is where software and sensors are embedded on everything from heavy farm equipment to other heavy machinery, mining machinery shown here in this picture for Caterpillar. to kitchen appliances and factory floor equipment, and lots of data being collected on the performance of these machinery and appliances. And they can be combined with other data sources, either in real time or historical data sources, and then used to implement decisions around reducing downtime, saving fuel, and improving safety. So this is one area. IoT sensor data has been at sort of the epicenter of the recent data proliferation. The other is collection and use of personal data as well. And there are lots of examples here, just a few that we're citing as part of this presentation. Insurance firms, there was recently an article in the New York Times that shows insurance firms collecting information on lifestyle through social media platforms and through fitness devices like Fitbits, et cetera, that they can use to actually price premiums on their clients, for example, and assess risk. Location firms collect a lot of data and sell it. One area or one industry that's interested in this is investment firms, where they can collect data on the traffic in and out of retail outlets, for example, or in and out of factory floors, to assess and estimate financial performance before the firms themselves even know what it might be. And then also lots of data collected in e-commerce on purchasing and browsing activities. Amazon is proud to claim that they don't sell any data, but they do use a lot of data to predict demand and improve their own services. So Stats Canada and BEA are collaborating in an effort on data stocks and flows, and we're asking a number of questions. What is the role of data in a modern economy? And I've outlined a few examples here. What is an appropriate typology of data is something that still needs to be sorted out. How are data currently treated in national accounts? And we've heard already that they're largely left out, and that was a decision, a deliberate decision, which was the right decision 20 years ago, but things may have changed a little bit since then. Who owns data is always an important question for intellectual property products. What are the different methods that national statisticians could use for valuation? We have the traditional sum of costs and market-based valuations, as well as income-based, but there are others available as well. And then finally, what is the value of data in Canada and in the US? And I'm going to provide a few preliminary cursory estimates for the US today. So we're not suggesting that all data fit within the scope of national accounts, and we're illustrating that using a data boundary shown in blue here. It's overlapping, superimposed over the S&A asset boundary in green and the production boundary in red. And as we've heard already, we want to allow for the possibility that data, or some data, are non-produced assets, of course, but could also be produced assets fitting in area C, and in some cases may not be assets at all, but still used in productive activities, so would be included here in area D. But then there's a large area shown for here, area A, which would be those data that don't fit within the scope of national accounts necessarily at all. And so how do we decide where data fit within all of these boundaries? Will require some sort of classification. We have not offered a classification framework yet. What we're showing here is adapted from recent work at the World Economic Forum as well as the OECD. And we like this one because it fits well into the S&A institutional sectors framework, right? We have households on the left, personal data, and then businesses, governments, and nonprofits shown on the right. And I mentioned already that in the US, we're focusing our initial work on personal data and IoT sensor data. Or focusing our attention because of the recent data proliferation in those areas. Also recent work at the OECD and Mauro Visconti, we've adapted a data value chain from that work. Shows a lower valuation at the beginning of the data value chain, and valuation or value increases as we move across the data value chain. At the beginning, under collection, data are unorganized, their accuracy hasn't been validated, and these can be considered big data or not so useful necessarily for productive purposes, collected through electronic payment systems, internet-connected devices like IoT, but also more traditional means like regulatory filings. Storage is the second stage. By the time we get to processing, value is starting to increase. Through analysis and fusion, this is combining data from different records to build a more comprehensive profile on firms or households. They become more valuable the bigger the record. There's distribution activities taking place through tracking companies and data brokerages and exchanges. And then by the end, we have the fifth stage, which is usage of data in either a data-driven business model. We hear a lot about that, but of course, governments use data for regulatory programs, and nonprofits for social programs, and households for general information and entertainment. So it's true that at the beginning, stage one, we definitely, if we're going to include data as an asset at that stage, that it may very well be non-produced at that point. But by the end of this, we definitely have some sort of produced asset if we're going to recognize this as an asset. So there are features of data that impose challenges for economic statistics purposes, for measurement purposes. Some of these features are shared with existing S&A assets, so they are non-rival, but excludable, so there's a risk of double and triple counting. But this is the same with other intellectual property products as well, and we have ways of managing that. There are maybe irregular depreciation profiles and may not fit our typical geometric pattern of decline once it's put into service. May experience appreciation at the beginning of its service life. Well, this is the case as well for other assets that fit already in the S&A asset boundary, like biological resources, for example, cultivated assets, orchards, breeding cattle, and other livestock. There are some features, though, that are also unique to data and impose challenges. They have characteristics of both goods and services. They're intangible like services, but storable like goods. And the value of data is context dependent. So it depends on how we're going to use data that gives it value. A picture of a puppy that's posted to Facebook may have a very different value to friends and relatives who are using that for entertainment purposes than if it's being used by Purina to target that household for a dog food commercial. The provision of personal data, and this has been mentioned earlier, by households at the beginning of the value chain is not customary in national accounts. We're used to households playing a role at the end of the production chain as a final consumer, but now we're talking about households playing a role at the beginning of the value chain, bartering their personal data in exchange for services from social media, internet search, and others. So we have come up with some very preliminary cursory estimates for value of data for the US economy. These are going to be flows and not stocks. We've looked at two different categories. One is purchase data products, and the other is own account data products. For purchase data products, we estimate this using receipts from our economic census, as well as our surveys, annual surveys on services. And we focus on two industries, information and professional, scientific, and technical. And we've identified 26 data products in the economic census that are either data related or data intensive. And for own account, we're using a methodology similar to own account software, using wages from our occupational employment statistics survey, including all industries except NAICS 5.1 and 5.4 because they're included above under purchase data. And we use a sum of cost methodology, assuming 50% of occupations' time are spent on data-related activities, and then we multiply this by a blow-up factor of total revenue to total payroll. We've identified 30 occupations that are data intensive, and this comes from a study that was conducted by the US Department of Commerce. We exclude occupations for own account software since they're already included in capital measures of software. So here we're looking at the preliminary estimates for purchase data. Increases from about $100 billion in 2012 to $133 in 2017. This is an average annual growth rate of about 5.5%. And this is our preliminary estimates for own account data, increasing at a rate of about average annual rate of about 6.7%, from 95.2 to 134 billion in 2017. So our next steps, we're planning to publish an update of the digital economy satellite account in the fall of 2019, so this year. And it is intending to include new estimates for cloud computing services, as well as expanded coverage for wholesale and retail e-commerce, the partially digital margins. And we're also making progress, but won't be incorporating any changes yet on measuring digital platforms. We're also working on a full set of digital economy supply use tables consistent with the OECD framework on digital SUTs, and continuing work on other aspects of digital economy, including treatment of data, and as well as free internet services and price and volume measures as well. So thank you.